Hello, I'm Emma O'Day. I'm Head of Marketing at Cashroom. You may or may not know what we do at Cashroom, but for those that don't, Cashroom provide an outsourced finance function for law firms. We employ over 100 accounting experts to finance over 230 law firms all over the UK. Today, my colleague Lynn will be going through some of the key points in the legal accounting rules that you need to know to run both a successful and compliant legal firm. We pride ourselves at Cashroom that all of our clients sleep easy at night, knowing that they are compliant with the regulators' rules. And today we are delighted to share some of our expertise. Lynn really is a true expert when it comes to the rules. She's been in our Cashroom team for over 10 years. Lynn also teaches the SOLAS course, and you may have seen her presenting at the Law Society of Scotland Cashroom roadshows over the last couple of years. So enjoy, stay compliant, and over to Lynn.
So the first question is, why do we have rules in the first place? Well, the Solicitors Scotland Act 1980 sets out the following objectives for the Law Society as being to promote not only the interests of the public in relation to their solicitor's profession, but also to promote the interests of the solicitor's profession in Scotland. The rules are there so that everybody knows how client money should be treated. It means that they know that if a solicitor can show they've complied with the rules, then there should never be a case that there can be a complaint against them, because they can show they've complied with the rules, they've followed all the procedures, they've done what they were meant to with their client's money. Complaints may come in other areas, but it can't be about how they've dealt with the client's money. Along with the rules, there's also guidance. It's not compulsory to follow the guidance, but if you don't follow the guidance and it does mean that there is a breach or a complaint, you would need to justify why you hadn't followed the guidance, and there would be quite a few serious questions asked. So making sure, yes, that they're not compulsory, but you really do want to sort of be following them. In tandem with the rules, we have the inspection process. And the purpose of the inspections is to ensure whether the rules are being complied with, but also to enable the Law Society of Scotland to fulfil its responsibilities as the money laundering supervisor appointed by HM Treasury. We now have the sort of tandem, that there's the sort of accounts and the separate money laundering inspections now. They've sort of separated them out now. So while your sort of normal inspection will be much more related to the rules, there will be separate inspections for money laundering now. So making sure that all these responsibilities are fulfilled. It also protects the guarantee fund, which obviously everybody knows that they pay into it. You want to make sure that it's being protected, and it promotes high standards of compliance within the profession and assists the solicitors in making sure that they know what they're doing with the rules, what the rules actually mean, what the interpretation of them is, to ensure everybody knows what they're doing and ensures everybody's doing the same thing. It used to be that inspections were something to be feared. It felt like a big stick, and it shouldn't be. They shouldn't be feared if you're properly complying with rules and you're able to show that you have the policies and procedures in place to ensure compliance. The inspectors are there to help promote high standards, and they're happy to give advice on procedures where they really need to be tightened up. In circumstances where it's just something that needs tightened up, they maybe won't even put it in the report. They might put in the report as a sort of low level, just to sort of to identify that it was noted and that it's been discussed and they've given advice. It just depends with something with a level 1 with no further action. Obviously, if there's other things that they have to report on that need to be addressed, there will be higher levels. But again, it's not something that you should be frightened of if you are complying with the rules.
So it's fair to say the rules, along with the inspections, are actually for the benefit of all the solicitors?
Yes, that's correct. You want to make sure that everybody's doing the same thing. It's a standard procedure across the profession. It shows if everybody's following the same set of rules in the same way with the inspections of those, then ultimately everybody knows everybody's following the rules. Ultimately, it will protect the guarantee fund, because if everybody follows the rules, there can be no complaints and no claims against the guarantee fund, and that helps everybody who has to pay into it every year. So it helps the whole profession. So any inspection will always cover compliance of all parts of Rule B6, but there are certain areas which I'd like to focus on today. So the first part is Rule 6.1 interpretation. And this, one of the most important parts is how you deal with your client account and where it's held. And the rule states that your client account must be held at a UK branch of a bank, which sounds really silly. Don't all banks have UK branches? But not necessarily. It excludes places like First Direct that don't actually have a high street process. They only have an online presence. So if they don't actually have a branch that you can walk into, you can't hold your client account with them. It also states that your client account must have client trust or other such fiduciary term in the title, making it clear that that is your client account and that is client money, not the practice unit's money, keeping it completely separate. When we're talking about practice units, that is the definition of what used to be a firm or a practice. They've made it a practice unit which covers all types of law firms. It reflects that not all firms are partnerships anymore. You have limited liability partnerships, you even have some limited companies. So anything that deals with solicitors, it becomes a practice unit. Again, solicitors, I'm saying solicitors, but the rules actually call them regulated persons. And instead of partners, we have managers. So it's just making sure that you're aware that when we talk about the manager, it's what we would normally think of as a partner. The next rule I want to look at is 6.3, the client's money to be paid into a client account or holding ledger. So this covers all the incoming money that's coming in to your practice unit and how you must deal with it. The main part of the rule is that you must have a float. This is the rule 6.3.1a, which says that the balance of your client bank account must be equal to or exceed the value of your client credit balances. So for this part of the rule, you ignore your debit balances if you have any completely. You look solely at your credit balances, and you must have enough money in your client bank account or accounts to cover those credit balances. So if every client came in on the same day and said, give me my money, you have enough money in the bank to give them all. To do this, to prove this, you must produce a daily float or deficit statement to prove that either you've got a float or, if you have had a problem, that you do have a deficit. So if you do have a deficit, you have to explain why you have a deficit, what has happened, what's gone wrong, and usually it's always best to say how you've investigated it as to why it's gone wrong and what systems and policies and procedures you've improved to ensure it will not happen again. And that would be declared on your account certificate, which we'll come to shortly. It also deals with the requirement of when you have to pay money in, and for any amount exceeding £50, which is currently the minimum amount set by the council, it has to be paid in without delay. This rule is actually causing quite a lot of problems recently with all the branch closures of banks, that people no longer have an easy bank to go to deposit their cheques or cash that's been received into the office, and say if it's over £50, it has to be banked without delay, which is normally the same day it's received. However, if your local branch is closed, that can raise problems. So quite often people have to have agreements with their bank that they're going to pay in maybe at the post office, at another bank. So say especially in rural areas where branches have been closing frequently, it can cause problems, but you must have some kind of arrangement. And unfortunately, my branch is closed is not an adequate excuse for the Law Society for having not banked client monies exceeding £50 as quickly as you possibly can. One of the newer parts, I say new because it's been there for over 10 years now, of this rule was the fact that you can have the creation of a holding ledger. this allows for the electronic equivalent of an held as undelivered cheque. So in the past, if you were settling a transaction, wasn't quite settled, but you knew it was going to, it just had one tiny little bit to finish off, you could say, okay, we'll send the cheque, hold it as undelivered. As soon as we get that go ahead, you can bank it. So it takes away that process of having to wait for the cheque to be delivered. So you could even send it in the post the night before, saying held as undelivered for the next day to be banked. And the Law Society wanted to give us the equivalent of that for electronic payments. It's less and less relevant now with the fact that banking cut-offs have changed since this rule came in. When this rule came in, the banking cut-off was 3 p.m. for most banks, not all, but most. So it was a case of if you were settling, you knew you were going to settle that day, it was getting close to 3 p.m. and you knew if you didn't send it, it couldn't go. You would send it to be held as undelivered electronically, it would go to the holding ledger. But as now banking cut-offs have changed, you can send CHAPS payments far later in the day or even a faster payment instead, which can be done 24/7. So it's becoming less relevant due to banking limits, but it's still there to be used if necessary. To say, if you know the settlement's happening, you're just waiting on one bit of documentation to finish it off or one thing to be agreed, you can send the money knowing that the other side will hold it as undelivered. They will credit it to this holding ledger. So it's ring fenced. It's still your money until you tell them it's delivered. So they cannot credit it to their client's ledger until you tell them it's delivered. It's not their client's money until it's considered delivered. So it has to be in this holding ledger. It ring fences them so everybody knows it's not that client's money yet, it's still yours. Then if something happens and the settlement doesn't happen, it's not been credited to that client ledger and it'll just be returned to you from the holding ledger. Or in best case scenarios, obviously, it settles, they can go, yep, brilliant, we've got that money in the holding ledger, move it straight to the client's ledger, the transaction is complete. So it just hurries everything along if necessary. But as I say, with the way that banking limits are and timescales, payments go so much quicker that it's becoming no longer necessary, but it can have its benefits. So it's still there for the moment. I think the Law Society probably will look at it in future and go, actually, with the banking system now, it's not necessary because you can send immediately. But at the moment, it is still there. The other part, it reflects back to Rule 1A, which we talked about the float. If you hold funds in a designated client account for a client, again, we'll talk further about what a designated client account is later. The rules are a bit sort of skew-whiff on that. The information on a designated client account comes after it's referenced. But if you hold money in a designated client account, you do not take it into account while calculating the float. But by the same token, you don't count the designated client account as a client bank when you're looking at the float. So it all sort of basically just removes it from the calculation completely. If you're wanting to put money on deposit for a client and you're looking at a notice account to get a better rate of interest, if it's a case that you're deposit funds in an account that has more than 1 month's notice on it, to get that better rate of interest, you need to have the client's written authority in advance of depositing the funds, just so that they're aware that if they need that money back, it's not coming back quickly for them. The other time you need written authority in advance is if you're going to overdraw an account in the name of the firm for a specific client. So this is dealing with bridging loans. Again, bridging loans are covered in further detail further on in the rules. But if you're going to operate a bridging loan on behalf of a client, and a lot of people do not do this anymore, they will ask their client to arrange their own bridging, especially in conveyancing transactions. But certainly in some executory cases, it's still a case that a bridging loan is required to meet inheritance tax liabilities. Then if you are doing that, then you need written authority in advance from your client. In this case, an executor would be the executor. Rule 6.4 covers the duty to rectify breaches. It's making sure that you're aware that this covers all breaches of the rules. A lot of people seem to think it's just with regard to the cash balances if you've got a surplus deficit, but it doesn't. It covers all parts of Rule B6, and that includes the failure to comply with money laundering regulations. So if you don't have your AML documentation in order, then that's a breach and it's covered by this rule. So your duty is to rectify that as promptly as possible. So just being aware that that covers everything. Rule 6.5 is the drawings from the client account. It deals with the drawing of the money from the client account, not for the purpose of making a payment on or behalf of to the client. So obviously if you're paying your client, that's normal. This is talking about payments where you're doing other things. So obviously anything that's drawn on the client's authority. You are allowed to draw from the client account in repayment of a debt or repayment due to yourself as a solicitor, as long as that outlay has already been incurred. So making sure, especially if you've got things like a purchase ledger, that it's not just that the invoice has been recorded in the purchase ledger, that the invoice has actually been paid to the supplier before you take that money over to your firm account. Again, with it covers the professional fees, and you can only take the money over from the client account to the office account where the fee has been properly debited to the ledger and rendered to the client. By rendered, we mean that the fee has been issued to the client, either by post, email, and in an inspection, the Law Society will actually look for evidence of the rendering of the invoice to the clients on your file, whether you've sent it as in a letter, you've sent it as a separate document, or you've sent it in an email. Obviously, again, we're talking about designated accounts again. You're allowed to transfer money over to a designated account for a client from the client account. When you're paying funds for on behalf of a client to a financial institution, a bank or building society, if it's the case that you're doing that by cheque, the cheque must include the name of your client in the payee line of the cheque. So say you were redeeming my mortgage, you would be making a cheque out to the Bank of Scotland for Lynn McAllen. The reason for that is if you made it out simply to Bank of Scotland, if that cheque was intercepted, anybody with a Bank of Scotland account could pay that cheque into their Bank of Scotland account. I had one case where I used to deal with debt recovery for a financial institution, and so you actually had to make the cheque out for the financial institution for the financial institution. So, for example, it would be Bank of Scotland for Bank of Scotland, which sounds ridiculous, but that's what you have to do to make sure that they can't be intercepted. The rule also lays out the requirement that you must act in accordance with the Council of Mortgage Lenders Handbook, and that's to make sure that solicitors are playing their part in preventing mortgage fraud. Rule 6.6 is the exceptions to when solicitors do not have to pay monies received into their main client bank account. But if they are doing that, they still have to record it through the ledger. And these cover things like cash that you've received that you're passing to your client without delay. So say a tenant comes in the morning with their rent and you know the client's coming in the afternoon, you can simply hand it to them. Again, it must be recorded. Similarly with a cheque that's made payable to your client, wouldn't make sense for you to bank it and then draw a fresh cheque to the client. You can simply pass that to them. Must be recorded through their client ledger. Where funds are being paid directly into one of our designated accounts, again, that doesn't have to go through your main client account. You can pay it directly into the designated account. If it's repayment of a debt due to you, again, where you have already incurred those outlays, say back to that, making sure if it's purchase ledger, the invoice has been paid, not just recorded. So if you've paid something out on behalf of the client and they repay you, you can pay that directly into your firm account. Similarly with fees that have been duly recorded in the client ledger and rendered to the client, in that case, they're not going to pay you the fee until you've rendered it, we would hope. But again, they can go directly into your firm account. You don't have to pay them into the client account first. Rule 6.7 covers the accounts required to be kept in the books of the solicitors. And it's basically making sure that everything that you have that you deal with on a financial basis is recorded. Anything that you do on behalf of the client, whether it's going through your client account, a designated account, or in the case of a third-party check, that you are recording them completely. It also says that you must balance your books on the last day of your accounting period. Your accounting period doesn't have to be a calendar month. You might decide that you're setting your accounting period to the 5th to the 4th each month to fall in line with tax periods. It could be that it so happens you started up on the 25th of a month and you decided that that's going to be your accounting period going forward. But whatever you decide, that is your accounting period going forward, and that's the dates that you must adhere to going for every month. So you balance your books on that last day of your accounting period, as say. Most people deal with a calendar month. By balancing the books, we mean the preparation of a client trial balance, showing all the balances that you hold for client ledgers, if it's debit credits, if you hold other funds, all itemised, and also producing a firm trial balance. It will incorporate the figures from the client trial balance, but only as totals. So whatever's on your client trial balance, the total will appear on your firm trial balance, along with the rest of your firm's financial information. The last part I want to talk about in this rule is the paid checks. So you've written a check to somebody, it's paid, the bank have cashed it, shows on your statement, you should be receiving those checks back from the bank. This has become more difficult. Banks used to just automatically return your paid checks to you. It isn't an automatic process anymore, and the Law Society wanted to reflect that in the most recent rules. So you can have them all returned. Quite often a bank will charge you for that now, but it now allows that you can get digital copies of the checks. There's one financial institution that will provide them on a disc. It could be that if you have something like Bankline, you're able to download the digital copies of the checks from the Bankline system if you have that, or you can have an agreement in place that the bank will produce on request a copy of the front and back of the cheque when required. However, it must be promptly, and making sure that the bank's idea of promptly and the Law Society ideas of promptly is the same. The bank might decide that 2 weeks is promptly. The Law Society will expect that to be quicker because it would be in the case of an inspection. They'll ask for it while they're on the inspection. They would expect it to be produced during that inspection time, which is usually a couple of days. So if you are going into that agreement with the bank, just make sure their idea of promptly is the same as yours. So Rule 6.8 is the bank statements to be regularly reconciled. This covers your main bank accounts, your main client account and office bank account, and they must be balanced at intervals not exceeding 1 month and for the same period that our trial balances are drawn. So going back to the previous rule where we must bring our accounts books to balance at the end of the accounting period, that's when your bank statements should be reconciled. Obviously, this is one of these ones where it's best practice versus the rules. You may wish to do your bank reconciliations far more regularly than that. However, the rules only ask for once a month at the end of your accounting period. You must make sure that your reconciliation statements and bank statements are retained for the full retention period, which is currently the remainder of the financial year plus a further 6 years. And you must make sure that everything is at the same date. So there's no point reconciling a bank statement that's an incorrect, it's not at the same date as your system date. So making sure that everything is to that same date. With Rule 6.9, it's the invested funds. Again, we talk about reconciling the vested funds before we talk about them. That's the way the rules are written. So if you have funds in designated accounts, they must be reconciled at intervals not exceeding 3 months. So quarterly, and again, they must coincide with the date of the reconciliation of your main client bank and firm bank and your end of your accounting period. So quarterly at the end of each accounting period. Again, these must be retained for the retention period of the remainder of the financial year, plus a further 6 years. And again, you must make sure all your statements are to the same date that you're reconciling. So that end of period date is very important. If you have any imbalances, you must record them and see how they've been corrected. We now move on to 610, which is the rule with regard to the designated accounts, and it tells you when you must use them. So when you're holding funds for a client, unless it's for the purpose of recording dues or land and buildings transaction tax, if those funds are likely to earn more than £100 worth of interest, they should be lodged in a separate designated account in the name of the client to earn interest. It used to be that you had to lodge funds if you were holding them £500 for 2 months, and you can imagine that used to get buttons for interest. So the Law Society did acknowledge that interest rates are not great and that there's a lot of extra admin involved in lodging funds for clients for very little money gained on interest. So they took the point that if it's not likely to earn £100 worth of interest, then you do not have to lodge it. It doesn't stop you if you feel that you should be lodging money for clients if it's not going to earn £100 worth of interest, but the rules state you don't have to. You might find that if it's an executory case, you know it's going to be going on a little while, you're going to lodge them anyway just to keep them ring-fenced and tidy in the designated account. But it's entirely up to yourself if it's not going to earn £100 worth of interest. But if it is, must be lodged in a separate designated account. That designated account, by its very nature, must have the client's name on it. So it'll be your firm for your client, and the interest that's accrued on that account is the client's money. It's theirs. If it's a case where you've held money for longer than you thought you were going to, and you've gone, okay, we've held that longer than we thought, and it would have earned £100 worth of interest, you will have to pay compensating interest to the client to make good what you would have earned. You have to show that you're compensating them with what they would have earned if it had been on a designated account. So if you do earn slightly more interest in a firm account, you're not have to give them the full interest rate. You have to give them what they would have earned on that designated account. It could be that you don't earn that much, so you have to give more. So it's sensible to make sure you're reviewing to make sure that if you do think it's likely to earn £100 of interest, you do lodge it. And as I say, and it can't be used as a backstop. It's a corrective entry only. You can't go, well, I'm not sure if it's going to earn £100, so I'm not bothering, I'll just pay them compensating interest if I have to. They do want you to think about it, and if it is, lodge it. Compensating interest is you rectifying the breach, not to be your standard process. Rule 611 is that matters to be held after conclusion of a matter. This is something the Law Society are very, very hot on. They like to make sure that balances aren't being retained by solicitors, that you are dealing with money when you're meant to, and you're not holding money unnecessarily. So all balances on client ledgers must be dealt with promptly in the rules. The guidance says within 2 months. So it's making sure that you are dealing with these balances as quickly as you possibly can once your matter is concluded. So if a matter is dragging on, it's not concluded, then you're still holding money, that's fine. You can hold that for as long as the transaction is relevant. But once it's concluded, you have 2 months to deal with it. If you're left with a balance of less than the prescribed minimum, which is currently £10, you can take that as a fee. You don't have to actually take time to return that to the client. The Law Society have acknowledged that sending balances for less than £10 probably costs about the same to send them. So they've said you can take them as a fee. It's not, you don't have to do single fees. You don't have to render a fee note. That would defeat the purpose. You'd be as well sending the money if you had to render a fee. They can be transferred to a small credit balances ledger, and then a single fee can be taken. But it must have a listing of all the balances and clients that it dealt with. Say it's the one time you don't actually have to render the fee note to the client to take it. If it's over that prescribed minimum but under the prescribed maximum, which is currently £50, and you no longer have current details for the client. So perhaps you've sent a cheque once and the letter came back as no longer at this address or along those lines, or you know that they've moved and you can't get in touch with them. You are able to send balances for less than £50 either to the Queen's and Lord Treasurer's Remembrancer or to a registered charity of your choice. The reason that you can send it to a charity as well as the Queen's and Lord's Treasurer's Remembrancer for balances under £50 is if you do send money to the Queen's and Lord's Treasurer's Remembrancer, they will charge you a fee of £50 to get it back. So if you're sending them less than £50, you're not getting anything back anyway. So let's give it to a charity instead. If it's above that prescribed maximum of £50, you are expected to make reasonable endeavours to trace your client. You can't just go, well, I don't know where they are. You have to have shown that you've made reasonable endeavours, and that must be relevant to the amount of money you're holding. So if it's £51, you're going to make far less inquiries than if it's 50,000. If you're going to record all your action taken, and you can take a fee from the funds held for any work that you've taken to find the client, including if you've had to engage tracing agents. If it's a case that even after those endeavours, you're still unable to transfer the money to the client, then they can be remitted to QLTR, the Queen's and Lord's Treasurer's Remembrancer. They will want to see evidence of what tracing you have done. So we have the Rule 612, which is the duty not to act dishonestly. And the main part of this rule, as far as the inspections go, is that it's considered to be dishonest or misleading to provide false accounting information to the financial compliance inspectors. So I know that they've used this to catch somebody who they knew was doing something wrong. They couldn't find anything in the paperwork because it had been very cleverly doctored, and so it looked like everything was fine. It'd been hidden, and because they'd provided the false accounting information, although they couldn't find what had gone wrong, they were still able to deal with the person using Rule 612. Rule 613 is the cash room manager. So as we went in the interpretations, when we're talking about managers, it's the old partner level of person that we're talking here, and it's making sure that one of your managers, the partner level people, is designated as the cash room manager, and they are then responsible for compliance of the rules, making sure that the system that you're using is correct, that all procedures are in place and are followed, and that any staff that you have in your cash room who are dealing with the client's monies are properly trained to comply with the rules. The next sort of chunk of the rules covers the account certificates, and any practice unit which holds client funds is required to submit an account certificate twice a year to the Law Society to advise them of what's going on basically with the money. If you have any breaches, they should be recorded on your account certificate, and you're going to produce one every 6 months. Usually it's your year end and 6 months in between. It doesn't have to be, but it's usually advised that you are. These are now submitted online using the Law Society's online service. So it's now a much easier process. It used to be paper-based and required 2 signatures. It's now online. However, if you're late submitting it, it may result in some serious repercussions for the practice unit, which could include suspending the practice unit's practicing certificate or an immediate inspection. So you want to make sure that you're getting these in, because you do have 1 calendar month to get in your certificate, and say it will cover the 6 months, but it will be broken down into 2 quarters. So you're going to be including balances. Say you're submitting a certificate in November, it's going to include balances at 31st of July and 31st of October. And what it's looking for is what's held on your client account, what monies are due to clients, so your client credit balances, and your surplus or deficit. We'd always hope that it's a surplus. It'll ask for how much is held for your designated accounts and if you have any bridging loans, how much is held for those. It also asks some questions about the financial health of the firm, such as, are you up to date with your HMRC payments? Have you been able to stick with your agreed banking limits, so you've not gone over any overdraft if you have one? So it's just sort of getting a sort of financial health check of the firm. One of the new parts of it is also it's looking for details of your most recent accounts that have been submitted to Companies House. So making sure that you have those details from your accountant to be able to fill in that part of the certificate. As I mentioned, any breaches that have occurred in the 6-month period should be declared. As I say, and it's always a good idea if you are having to declare a breach to explain exactly what's happened, what investigations you've taken into it, and what steps you've taken to ensure that it doesn't happen again. They always like to see that. 619 is about bridging loans. Say we mentioned them previously. If you are arranging a bridging loan on behalf of the client, so it's not just the client's gone to the bank and got a bridging loan, that doesn't apply here. It's if you are arranging a bridging loan on behalf of a client, you must always advise the bank or lender of the name and present address of the client for who the loan is being taken out in writing, which usually would be in the case of the application form, and you must make sure that you're showing the arrangements for repayment of the loan or overdraft facilities. So making sure that you're saying, okay, in a conveyancing transaction where you're bridging when the sale property will be settling, and that you're going to be arranging the repayment from those sale proceeds, or if in the case of it's an executory to pay the inheritance tax, that it be paid once confirmation has been received and heritable property is able to be sold. The last part of it is you must make sure that if you are arranging it, that there is no liability on the practice unit. The liability is solely on the client, despite the fact that you're arranging the loans. So this is where a lot of people think that it's not their best interest to arrange bridging loans for clients anymore, and we'll ask them to arrange any bridging for themselves. Rule 620 covers borrowing from clients. A solicitor must never borrow money from a client unless either they're in the business of lending money. See, I mentioned before that one of the firms I worked for did a lot of debt recovery work. We did debt recovery work for the bank that we banked with. So this rule allowed us to still have an overdraft with them, because it would be daft when they're in the business of lending money for them not to give us an overdraft, or if they have received independent advice prior to making the loan. As I say, it's making sure that the client is protected at all times. Rule 621 is the prohibition of a solicitor acting for the lender to the solicitor or connected persons. In much more simpler terms, you can't deal with your own standard security or that of anybody else within your practice unit, or any other sort of manager level people within your practice unit, or any of your partners in life. So if you have a spouse or civil partner, you cannot act for their standard security either. You can act for your conveyancing transaction, but for the actual standard security, the drawing down of the mortgage or redeeming of the mortgage, that must be dealt with by somebody wholly unconnected with yourself. Again, this is in compliance with the Council of Mortgage Lenders Handbook, and to make sure that we've not got any mortgage fraud going on. Rule 622 is the powers of attorneys. So if you are dealing with powers of attorneys on behalf of clients, so this isn't just a case of somebody's drawn a power of attorney in favour of their daughter and you hold it in their safe. That's not covered by this rule. This is where the power of attorney is actually in favour of a regulated person within the practice unit, to make sure that where you have power of attorney over a client's financial situation, that you are dealing with the financial properly. So if you have control of any bank accounts, they should be brought into your books and records as part of your designated accounts, and you must make sure a list of the powers of attorneys which have been granted within the accounted period are submitted along with your 6 monthly account certificate to the Law Society. It's just so they can keep an eye to make sure that people who have power of attorney are not mishandling the client's money. The final rule we're going to look at is 623, money laundering. Now, obviously, money laundering is a massive subject, and this could be a massive topic on its own, so we'll just touch on it. That the rule states that you must comply with the money laundering regulations, which includes that you must have a money laundering reporting officer, that you must establish risk-sensitive policies and procedures. You have to make sure that you're verifying your clients under the client due diligence or enhanced due diligence procedures, that you're making sure you're monitoring any business relationships to make sure nothing changes. And most importantly, do not act until you've verified the identity of a client, and do not act at all if you cannot verify a client. Making sure you've got full and detailed records of that, and being aware that your staff are properly trained in the anti-money laundering procedures. You might think, oh, it's only the solicitors that need to deal with that, but maybe the cash room staff need to be trained. And then you go, well, actually, the person who deals with most of the ID is our receptionist, so maybe they need training as well. So just making sure that you're training all appropriate staff in the anti-money laundering procedures. As I say, and I could talk for hours on anti-money laundering. I won't. We'll stop there. Thank you very much for your time, and I hope you found this very informative.